Good afternoon. Welcome to this fifth webinar in our series on challenges for bank board members. This is our fifth seminar, as I just mentioned. We're going to have 3 more online seminars in this academic year before the summer break. Next month, about possible consolidation in the European banking sector. Early May, sustainability challenges for banking. And then at the end of May, a conversation between banks, board members, and policymakers, where we will have Andrea Enria and Carlos Torres Vila, the chairman of the of BBVA. This is part of a wider initiative, the Bank Board Academy, which we introduced last year, and kind of the first main event will be the training programs that we are offering in June. 4 or 5 Friday afternoons online, sitting on boards, better check and control of risks, and then hopefully residential training, circumstances permitting, at the beginning of October on better quality and better governance, which is directly targeted at non-executive directors on bank boards in Europe and beyond. Again, for more information, there is a website. If this website is too long for you, fbf.eui.eu. It's a relatively easy to remember website where you can get all of the information, plus lots of things on information on our other activities. So with that, having said that, let me turn now to today's topic. We've been talking a lot over the recent years of low interest rates, or low for long. The last year has kind of pushed us towards lower for longer, with the perspectives that there will be even 0 or negative interest rates for many years to come. It's not just monetary policy decisions, but also secular trends in growth, productivity, demographics, and so on, that drive these very low levels of interest rates. Now, the topic of low interest rates has, of course, many, many aspects to it. In this context, we really want to focus on what it means for banks, for their business models, for the activities they get involved in, interest generating, non-interest generating, but then also especially what is the role of bank board members, especially of non-executive bank board members, in terms of driving these necessary changes in banks' strategy, challenging their management, and so on. For this, we have 3 excellent speakers. And we'll give very short presentations, so we're going to have time for Q&A. I will introduce them in the kind of the reverse order. I'm going to start with Vitor Constâncio, who will speak last, who was the vice president of the ECB from 2010 to 2018, and before that, the governor of the Banco de Portugal from 2000 to 2010. And he has a long career in both government and academic service. And of course, he probably doesn't even need an introduction. He's well known also to our audience. We will have Julie Galbo, who is currently serves on the board of DNB Bank ASA, and also as an observer in the Risk and Audit Committee. And she also serves as a chairman in 2 other Danish companies, a software company and a stockbroker. And also she has a long career in both private sector, but also in regulatory authorities. And then actually our first speaker will be Thomas Vlassopoulos, who is the head of monetary analysis division in the ECB, who has a long career within the ECB and before that at the Bank of Greece, again in monetary policy and in economic research. So as you can see, we have very diverse perspectives, also very different national perspectives. And I will now first turn over to Thomas. If you can also share your screen, please, and tell us a bit about lower interest rates from the viewpoint of the central banker.
Thank you, Thorsten, for the introduction, for the invitation, actually. And good afternoon, everyone. It's a pleasure to be here with you today, especially among such a distinguished set of panel members. So the perspective that I bring to this discussion is indeed, as Thorsten also mentioned, that of the central bank, and in fact, the monetary policy arm of the central bank. And with this in mind, I thought that what might be useful and interesting in this seminar is to offer some considerations on the drivers of the level of the rates, and then to draw some implications for banks. And in the interest of time, I will probably only focus on the profitability aspects. So let me start with some mechanics about the components of long-term interest rates. So we think of long-term interest rates, say the yield on a long-dated bond, as being made up of two components. The first component is the expected path of short-term rates over the life of the bond. An investor should get the same return by investing in a long-dated bond as they would if they were to invest in a short-dated bond and roll that investment over the same total period of time. Now, of course, we know that these two investment approaches or strategies are not entirely equivalent. And when an investor commits to a longer-term investment, they are exposing themselves to some risks, and they need to be compensated for these risks. So on top of these expectations for short-term rates, we also have premia. And these premia reflect a number of things. The first that I have listed there is the term premium. This refers to the fact that there's uncertainty about the expected path of short-term rates. And if they turn out to be higher than originally expected, then rolling over short-term rates would in fact result, short-term bonds or investments would in fact lead to a higher return. And therefore, because of this uncertainty, investors need to be compensated by the so-called term premium. And then there are other kinds of premia. So for instance, to cover themselves for the risk of missed cash flows. If there's a credit event, there's the credit risk premium. And also there's a liquidity risk premium that compensates investors for the risk that they may need to liquidate that investment, terminate the investment before its maturity at a loss. Now, let's go back to the expected short-term rates. The rates that are typically quoted in markets are so-called nominal rates, and they are made up themselves of two components. One component on the right here is expected inflation, the compensation for the fact that the sum lent out today will be, the value of that sum will be lower in the future, assuming a positive inflation. So the amount of goods and services that investor will be able to buy in the future would be lower than it currently is. So that's the compensation for expected inflation. And then if we filter that out, we are left with the actual expected real rate. And the question is then, what drives the expected path of real short-term rates? Now, banks and investors at large typically translate this into a question of what is the central bank expected to do over that period? To what level will it seek to steer short-term interest rates? Now, the central bank itself aims to meet its objective, in the case of the ECB, to maintain price stability. And in order to do so, the central bank tries to keep rates close to the so-called natural rate of interest. This is the rate of interest that is consistent with the economy operating at its potential and with inflation being in line with price stability. Now, the natural rate of interest is unobservable. We cannot directly observe and measure it, so we have to rely on estimates. And on the left-hand side of this chart, I have plotted a range of estimates for the euro area natural rate coming from a wide array of available studies that you can see there below. There are 2 points to make here. First, there's quite some uncertainty regarding the precise level of the natural rate of interest. But more importantly, what you can see is that there's a clear downward trend along, regardless of the specific study and estimate that one looks at. There is a clear downward trend. And in fact, this is not a pattern that is unique to the euro area economy. We see that very clearly also for the US and all major advanced economies. So it's a secular downward trend. And this is due to reasons that Thorsten already mentioned in his introduction. I've listed here on the right side, the fact that productivity growth has slowed down in advanced economies. Moreover, demographics, we have population growth slowing down, and with this comes also aging. And this, with the aging, so this has an impact on potential output, but aging also has an impact on demand for savings, for safe assets. And as a result, we also have safe asset scarcity, which is also compounded by the fact that many emerging market economies are building up in the face of macroeconomic volatility, are building up reserves of such safe assets as an insurance device against the risk of sudden stops. Now, why is this relevant for our discussion today? Well, because it shows that the factors that have driven rates to low levels are slow-moving, secular trends. And this means that they are likely to remain at low levels also going forward for an extended period of time. And they will not be rapidly reversed, even if there is a cyclical upturn of the economy. And this in turn implies that banks need to devise and implement strategies to adapt and adjust to this low level of interest rates. Now, let me turn to what has happened to actual rates. And here I show the term structure of IAS rates, so a typical risk-free market rate. And I show the term structure, so the level of that rate for various tenures from 3 months to 10 years, as it stood in January 2014, before the credit easing of the ECB started, and then the asset purchases of the ECB started in 2014 and 15, respectively, and also a more recent curve from Friday last week. And what you can see very clearly, well, you can see that the clear downward shift in the curve. That's one thing, but what is perhaps even more striking is the flattening of the curve, the fact that long-term rates have moved down much more than short-term rates. You can see that the red line is flatter than the blue one. And I can come back to the reasons that have led to this, but in the interest of time, let me move on to the implications of this for bank profitability, going through the various components of bank profitability that I've listed here on the right side. So banks are typically in the business of funding themselves using short-term instruments and then lending out at longer maturities, conducting what is typically called maturity transformation. And when the yield curve is flat, that means that the difference between long rates and short rates is small, and this in turn means that the net interest margin that banks can earn is compressed. So the impact there is clearly negative. However, and perhaps I should add that this negative effect is likely to be more acute if we have not only low rates, but we in fact have negative rates. And this is because banks, of course, rely on retail deposit funding, which is typically floored at zero, with some exceptions. We can again come back to that. And the other point here is, of course, that the compression of net interest margin becomes more acute the longer the period of low rates lasts. Why? Well, because legacy portfolios of previously high-yielding assets eventually mature and get replaced by assets with new assets with lower returns. However, there is a compensating factor, and that's low rates typically encourage more borrowing by firms and households, for instance, because more projects turn out to have a positive NPV if rates are lower. So there is a larger intermediation volume. So although the margin, so the per unit of intermediation profit is lower, there is a larger volume of intermediation, and this offsets to some extent. Let me now turn to non-interest income. And the first point is capital gains. Of course, when we have lower rates, that means that the price of the underlying assets tends to be higher. And therefore, depending on where banks hold these assets on their accounting portfolios, they might be able to post some gains. But of course, we should recall that these gains are one-off. They are not repeated every time or for the period that rates remain low. They happen only when there's a downward movement. The other part is net fees and commissions. And here we have a similar argument. When we have higher asset prices, then turnover in markets tends to be higher. And therefore, banks, when they intermediate these transactions, can earn higher fees or higher commissions. And there are additional reasons to think that there might be a positive effect on fees and commissions, for instance, because low rates might encourage a so-called search for yield. So again, that would speak to higher trading volumes. And on top, less, let's say, sophisticated investors might find themselves with a need to rely on professionals for managing their portfolios, and that again can be a source of income for banks, but importantly also for non-banks who are competing also for this business. And finally, and very importantly, we have loan loss provisions, so which is a cost obviously for banks. And here low rates make the debt service burden for borrowers much lighter, so they are more likely to be able to service the debt, and therefore banks will ultimately face lower credit losses and have to book lower provisions. Of course, then the end result of this is unclear, because we have a series of positive or potentially positive effects from low rates, and we have a clearly a negative effect here, and it's unclear what the net impact is. It depends on factors such as the funding structure of banks, whether they are heavily dependent on retail deposit, but it also has to do with bank-wide or system-wide phenomena, like how long rates have been long for. And let me stop here so that we can discuss.
Thank you very much, Thomas, for this very nice introduction, the overview. If I may have one quick question. So you made some would argue, a strong statement in the sense that you expect these rates to stay low for much longer because of the kind of secular trends. That kind of goes a bit against what some people fear in the bond markets, maybe less in the euro area, but for example, in the US, where there is a lot of kind of rumor or talk that interest rates might actually increase. I guess first more in the longer term, longer part of the yield, and then more in the shorter yield. I mean, so what if it's really a euro area? And of course, the ECB is for the euro area, that's obvious. But what if you see rising interest rates in, I don't know, a couple of years in other major economies, like especially the US and not in the euro area? And this might also imply additional shocks for the banking system. How do you see that?
Yes, so to the extent that that rates, long-term rates are higher in other economies, there is very likely, and we have seen it already, to be spillovers for the euro area. Now, this is if this is a phenomenon that is entirely driven, that is entirely imported and doesn't reflect the true underlying strength of the euro area economy, I would say probably this is not a welcome phenomenon also for banks, because it would imply that the outlook, the macroeconomic outlook, would be worse than it would otherwise would be the case, and that would mean that credit losses would be higher. And this is particularly pertinent in the current environment, the current post-COVID environment, where firms have saddled themselves with large amounts of debt in order to be able to see through or to bridge the period until the social distancing measures can be withdrawn. Now, if the interest rates start being raised and fiscal support measures that have made this situation possible are at the same time withdrawn, that will expose, of course, banks to credit risk, and would crystallize credit risk that could be in principle already on their balance sheets, but are prevented from actually materializing because of the support by fiscal authorities, but also because of the low level of interest rates.
Sorry, I should unmute my first. Thank you very much, Thomas. Now, of course, you're kind of getting into another discussion, which I think we're going to have for a long time to come. How do we get? What is the exit strategy for the COVID crisis? But let's maybe leave this to the aside for the moment. Let me turn to Julie. Kind of looking at it more from the bank side, and of course, you also as a bank board member. I mean, do you agree with the analysis on these? The pluses and the minuses, and most importantly, of course, what should banks do about it, especially if we stay really lower for longer?
Thank you. Well, from a very practical perspective, I think I'm a bit more pessimistic than Thomas, so I'm glad to hear I'm wrong. Having said that, I think there are a number of challenges out there, so I'm very happy that I've been invited to talk today. and to discuss afterwards. Basically, banks have two sources of revenue, as Thomas mentioned. There's the interest-based income, such as credits, and then there is fee and commission-based income, which has typically been wealth management and to a certain extent payments. Interest income is, as we've just learned, heavily affected by the low interest environment that we live in. That's undebatable. On top of that, I think it's important to remember that regulatory capital requirements have imposed constraints both on interest income as well as net fees and commission income. And essentially it limits income from both maturity transformation and from credit risk taking. So for banks to increase interest income, the only way may be to increase the risk profile. And such an increase, we have to remember, of risk profile is very effectively set off by an increase in capital requirements. And strangely enough, and I'd be happy to have Thomas's or Vitor's view on this, credit spreads at this point in time are quite low. So the practical reality is that I see very few banks that, without growing their customer base, can actually increase their interest income substantially. And as for fee and commission income, as I mentioned previously, the market is super competitive. And we have to remember that it's not only the traditional banks that we are competing with. It is also a number of new entrants. And with the requirements regarding consumer protection and transparency that exists or have been given in, for instance, MiFID, increasing margins is not a super likely way to increase revenue. And as for the historical income that used to come from markets divisions, prop trading, which has for many been a nice source of income, is very limited compared to what it used to be. So that's not really part of the equation anymore. Payment services, also a major source of fees and commission income historically, is now being squeezed due to new entrants in open banking after PSD2. So what do we do then? How do we think about sustainable business models? I think setting it out a little bit unsophisticated and very plainly, you can either grow your customer base or you can reduce your costs. Banking is being commoditized. That goes both for credits and for trading. And thus, one has to accept that it's a cost and scale game going forward. We have neobanks, we have payment service providers that are entering the arena and that do provide low-cost banking products and services to consumers as well as to corporates at prices that are way lower than what the traditional banks have historically been able to offer. Now, I should say this is probably from a European economic perspective, very, very healthy, but it's also difficult from a banking perspective. And thus, you are faced with a choice. You can probably choose either going digital or merge or partner with somebody who's already digital in order to reduce your cost base. You may think about using artificial intelligence to reduce the costs of servicing customers through smart self-service solutions, both in the credit and basically any other traditional banking product it can be used. And you can use AI to replace people in the fight against money laundering. I think this was discussed at the last seminar as well. But automation is probably the way forward. This obviously requires boards and the organizations they run to assess the current business model and make the necessary adjustments with a view to ensure that the cost base is long-term sustainable, given a world where margins income is likely to decrease rather than to increase. And that's obviously painful, but probably the alternatives are a lot worse. So I'd encourage all of you to think about structural change to the business models rather than fragmented cost savings by, there are many who try to do a little bit of saving here and there by, for instance, nearshoring labor-intensive tasks, but maybe the right solution is to move into a more digital business model. And we have to remember that not only have we been hit by fairly rapid change during the last 10 years since the crisis, but it's happening around us. There's been substantial development in the payment space since the implementation of PSD2 in open banking. How many of us, how many of you had correctly assessed the impact and dealt with it beforehand? How many of us had anticipated that customers have been rather satisfied during COVID-19, despite the absence of physical interaction with bank service staff? It is probably time to rethink the way we have done banking historically. And finally, I'd like to mention that all those new entrants, they tend to provide aggregator services like Google or Amazon or Apple or Tink. And they're rather likely, in my opinion, to be the next big issue from a conduct perspective. So perhaps regulators should start focusing a bit more on those going forward in order to ensure a level playing field. Just a thought. Thank you.
Thank you very much, Julie. This was very insightful. Before I'm going to kind of summarize and then follow up, just to mention to the audience, please ask your questions in the Q&A box. I will focus on questions that relate directly to bank boards and bank governance. Now, Julie, I mean, I think you gave a very kind of broad overview and lots of challenges, right? I mean, it's about the business models, it's about the cost base, it's about the fact that the threat from new entrants, fintech, big tech. It's about the possibility of mergers. Now, if I want to kind of, I'd like to push you a bit more. You as a board member, I mean, how do you go about this? I mean, you have, of course, management on the one side, bank management, either thinking more like how do we react in the more short term, medium term, of course, also now the crisis that we are still in, or that we might get into at some point, or more on the longer term. I mean, how do you see yourself as a kind of non-executive director in this debate that you as a board member have with management on how to address this kind of the long-term challenge of lower for longer?
That's a very big question, so I'll try to answer it in a not too lengthy way. First of all, there is a question about board composition there, where I think the SSM requirements on the new fin proper requirements for boards and bank board members are quite reasonable. And quite frankly, should be addressed or embraced by the industry. But obviously boards need to be competent in terms of understanding the challenges ahead, and also in terms of understanding the possibilities that lie in tech. You mentioned big tech, you mentioned, and I'd like to bring forward fintech, all the collaboration, the possibility to do partnerships with various fintechs can really do a lot of good for banks. But apart from that, banks have a substantial role in ensuring that management is fit for purpose. And basically, I'd offer the hypothesis that banks maybe should not be run only by bankers. Maybe banks should be run by bankers and techies. Okay. Because if you want to drive a transformation in a certain direction, you will want to ensure that you have the competences readily available, and probably there needs to be tech competences amongst very senior management in banks that have a fairly standard business model.
Thank you very much, Julie. I think you just actually that was a bit, I think actually big statements, very insightful. So banks should not just be run by bankers, but also by techies. So that's Vitor, if I may come to you. I think you also have a short presentation. Kind of relating to what both Thomas and Julie have told us.
Well, thank you very much, Thorsten, for the invitation. I do have some slides, but before that, I would like to make two caveats to what Thomas said. The arguments presented by Thomas I have used them myself in speeches when I was at ECB. Indeed, in 2014, I disclosed in a lecture at Utrecht University in the Netherlands the first estimate of the real equilibrium interest rate produced by experts at the ECB. So that this is, say, the mainstream view about these things, but there are two caveats that we should keep in mind. First, the fact that the estimates of real equilibrium interest rates reappeared in publications by Laubach and Williams long after the 2008 and 2009 crisis. They renewed their old paper of 2003. I don't remember exactly, 2013, 14, and then a flurry of other estimates occurred. But long before those estimates, central banks had started, particularly the Fed, in a way to lower rates, to go for lower rates with the very good argument, still valid, that lowering rates would promote higher expenditure by private agents. And that was the reason not to pursue a firm, believed estimate of what would be the real equilibrium rate of our economy. So monetary policy has influenced the, of course, the development of interest rates. And second, the analysis of the yield curve that Thomas presented, which is very, very well and very mainstream, is totally based on the expectation theory of the yield curve. And there have been many econometric papers disproving that the pure expectations view of the yield curve really works. It's grounded on very rational expectations and all of that. And there are many econometric studies, and I remember one by Alan Blinder, showing that in fact, there is an undue effect of present short rates on what happens to the longer rates. So the pure expectation view of the yield curve, well, there is a big reason for discussing that. Those two caveats, which nevertheless, in the overall assessment of these things, have some meaning. But turning to our subject more directly, and Thomas presented, of course, very well the arguments of what can be the effects on the profitability of banks. And now I turn to my slides. So here they are. I start with this one. Let me expand it. Yes. So what Thomas indicated is shown in this chart, which is also from the ECB. Unfortunately, it ends on 2017 from 14, when the package of policies that we approved then had a big impact on a renewed decline in interest rates since mid-2014. And as he said, we see here for several countries and the euro area as a whole, that the negative impact of reduction of net interest margins was offset by a lowering of provisions in view of the higher growth that the ECB policy induced, and also from the one-off capital gains resulting from the lowering of interest rates, and then of course the increase in valuation of financial assets. And the two things have been offset each other, so much so that in the round gray points, we see that the return on assets of these banks throughout this period of 14 to 17, and I'm not aware of the ECB publishing a more updated similar chart, but throughout this period, we see that profitability or return on assets has not changed, because the two various components have offset each other, which is an important consideration, even though some of these effects, like the capital gains, are mostly one-off, which raises the issue that the prolongation in time of very low or negative interest rates will start to have a more negative effect down the road. Now, in spite of that, if we look the present margins, interest margins, on the left of this chart, we see that for corporations, the credit interest rates in the more very recent period until January of this year is still, nevertheless, in spite of the low rates and so on, it's slightly higher than 1.5% of the total assets, despite being reduced, but still sizable. And it's slightly lower for households because banks did not decrease in general rates for deposits of households. Nevertheless, the percentage of deposits in the euro area banks that already use negative rates for corporations attained already 25% of total deposits of non-financial firms. And for households, it's very marginal, as we can see in these. But nevertheless, interest margins and what the banks have done there in managing the situation still allowed for visible, although reducing over time, net interest margins. Nevertheless, in terms of change of those margins, we see in this chart that the change in the net interest margin, the change, it's not the levels, has been positive in these years, in these periods since 18, because the decrease in the margins themselves, or in the change in the margins, was totally offset by the increase in volume of credit. And so the net effect on the change was positive, but it turned, of course, negative last year with the pandemic situation. But what is more interesting is the chart on the right, because it tells something about business plans and what banks are doing. We see there that consistently the Scandinavian country banks have kept a return on equity above 10% throughout this period since 2013, whereas the euro area on average is much lower, and the US has almost attained the same level, more recent, of the Scandinavian countries, because there was a decrease in taxation on profits of firms in the US. Without that change in taxation, the return on equity of banks, of US banks, would have been this dotted line here. So the tax effect was very sizable in the case of the US. So what these performance of Scandinavian banks tell us about what banks can do. And that's my final chart, which is a table, where I show that for several countries in the euro area, and then for Sweden as a representative of the Scandinavian countries, we see that the rates have been in Sweden, if anything, even more negative than in the euro area. And in spite of that, we have return on equities. I highlighted the full numbers for the whole year of 19, but they are different, but not qualitative different from what we have in the first 3 quarters of 20, which are the latest numbers available. And we see that the return on equity in Sweden banks was 12%, and it has been 12% throughout many years. You know, no comparison with what happened in the euro area in general. Why is that? Well, it's not in the table, but it's not because of fees and commission. In percentage of total revenues, they are similar to what happens in in the rest of the EU? No, it is due to three factors. First, the NPLs ratio is much, much lower in Sweden and Scandinavian countries in general than in the rest of the EU. And that's, of course, very important. But it's not, of course, only due to the good management of credit risk by the banks, which has been good, no doubt, but also it's related to cultural data about the population in Sweden. And, you know, if we want to go back to Max Weber, to Protestant countries where personal responsibility is taken more seriously, and disciplined population helps here the banks to be compliant. So, but it's nevertheless a lesson. The second one, we see that the cost-income ratio of banks in other countries and in the Swedish banks, again, big difference, much lower in Sweden. And it used to be even lower than that in 17 and 18. There, I'm not sure. But perhaps more significant is the relationship between total costs and total assets. And there, the difference I have, it's a bit old, but I had no time to, you know, it's complicated to calculate, to sum up all the costs in banks from the database of the ECB. And so I didn't do it for a more recent period. But it has been like this throughout time, is much lower, this ratio between costs and total assets, again in Sweden banks and Scandinavian banks in general. And that's very important, and it's related, and this ratio, cost over total assets, to me is more meaningful than the cost income, which numerator and denominator can be more volatile than this ratio here. And this has to do with many things, not only to impairment costs, but also to digitalization of banks. There are vast regions in Scandinavian countries where there are no branches of banks at all. And we know that notes and coins have been disappearing in use, particularly in Sweden. All that helps these reduced costs, but points to digitalization, to reducing the number of branches and all of that, which again is related to the level of general education of the population and the use of digital means of payments. But as a result of all these, the risk density in Scandinavian banks is much lower. The ratio between risk-weighted assets and total assets, which explains why, besides the higher capital ratio resulting from that, return on equity, which is high, becomes possible. So here we have a sort of menu of things that make a distinction between what has been happening to banking sectors in Scandinavian countries, which points to very good credit risk management, which points to heavy digitalization and reduction of costs as the strategy that have ensured, despite the very low and negative interest rates, has ensured high returns on equity. And I think the lessons from these indicate that the low rates are not an insurmountable problem for banks to become profitable. Thank you.
Thank you very much, Vitor. This was very insightful. I'm going to turn, of course, to Julie in just a moment, because she's actually, of course, based in Scandinavia and Denmark. But let me ask you very quickly, Vitor. So I mean, on the one hand, the Scandinavians have shown us how to do it. Why are we not doing it in the rest of Europe? And what exactly can be done for kind of a similar approach to be adopted in the rest of Europe? Or is it specific Scandinavian circumstances, to which I'm going to come in a moment. Like, for example, that you have a couple of very large banks. There's a highly integrated banking market, for example, in Scandinavia, and so on. So to which extent can we actually kind of learn from the Scandinavian experience to the rest of Europe?
I think we can learn, but of course the experience in Scandinavian countries cannot be easily reproduced in other European countries. I mentioned several times that cultural aspects and level of education of the population and general use of digital means makes a total difference for what the banks can do. So, but nevertheless, there is a lesson, but we also know the limits of that lesson that has to do with the whole environment where the banks operate. This is, as you hinted, not the result that the banking sectors in Scandinavian countries there is more competition than in the rest of Europe. No, it's not like that, although there is competition, of course. But also, it's also true that the levels of overbanking are lower in Scandinavian countries than in many continental European countries, where, of course, overcapacity hinders very much the possibility of having higher profitability rates. So to change that is your next webinar about consolidation of banks in Europe, which is one of the answers to this question, and making possible that indeed other banks follow this pattern, although, as I said, not being able to totally reproduce the experience of the Scandinavian countries.
Thank you very much, Vitor. Sorry, Thomas, yes?
Sorry, I thought, sorry to interrupt, I thought to add one point to what Mr. Constâncio said about, let's say, the difference between Euro area countries or banking systems in Euro area countries and well, there are many differences, but one that might be quite relevant here is also the different funding structure. So Swedish banks, Danish banks rely a lot on market-based funding, covered bonds and others, and that means much more than Euro area banks. So Euro area banks, for instance, on aggregate, have deposits that are 55% of their funding structure. In Sweden and Denmark, it's 49%. And therefore, that means that they're less, they're better able to adjust their funding costs, especially when interest rates fall below the zero line. So just to complement, I think it complements what Mr. Constâncio was saying.
Thank you very much for this. Thank you, Thomas. Let me maybe turn to Julie and back kind of to the topic of bank boards. So it seems that your colleagues in the other Scandinavian boards have done everything right. What is your reaction, Julie, to what Vitor just told us, the lessons that we can learn? I mean, he showed the data for Sweden, but I assume they look somewhat similar for those Scandinavian countries.
First of all, it's the highest level of praise that one can get. So thank you for that. I think there are things that bank boards in Scandinavia have not done well. And the one thing that Mr. Constâncio mentioned is that in Scandinavia, we are born into a welfare society that is extremely well functioning with a very high degree of payments despite unemployment. And that means that our mortgage portfolios have effectively never suffered real losses. And that goes throughout Denmark, Norway, Sweden, and Finland. I think the picture Mr. Constâncio painted of cost-income ratios are correct across the Nordic countries. I think it's somewhere between 40 and 50 for the 5-6 large banks these days. Nordea is just where I used to work in exec management. Now a Eurozone bank. I think it's just below 50, quite effective work on that, quite a lot of work on digitalization, which has had an effect. It also means that we have been in the Nordics in place for digital distribution models years ahead of COVID. So we were well positioned when the crisis hit. And that's been obviously extremely fortunate, but it also means that we have experience with digital distribution models and how to make them work, and probably have been a bit better at embracing new technology. And that's been quite beneficial. And here again, I think Mr. Constâncio quite correctly mentioned that the high levels of education across the Nordic countries do tend to make a difference. It means that there is an understanding of the need to be aware of what's going on in the outside world and to embrace the opportunities offered by technology. Right, also about wholesale funding is Thomas. In most of the Nordic countries, or all of the Nordic countries, I think also households are met with negative deposit rates as a standard for deposits over roughly 12,500 euros. Then you enter negative territory, and that obviously means that the funding model, it has been partially wholesale funding, partially deposit funding. Now it's very skewed towards wholesale funding for obvious reasons. There are corporate deposits also for obvious reasons. But it has affected the broader picture, and it does if you're good, and it's quite complex to manage funding structures because there are so many constraints imposed both by regulation but also by credit rating agencies. You get quite a good understanding, and that you can only manage the complexity of the portfolio of funding or the portfolios in terms of credit if you have good data points. And therefore, I think a lot of the Nordic banks have been doing a lot of cleaning up or transitioning towards a state where you can do data-driven management of banks. You get good credit risk management, you get good management of basically all your risks if you have very structured data. And here I think, again, that my personal opinion, and it may not be shared by many other bankers, is that TRIM is one of the biggest gifts the SSM has ever given to banking, simply because it has forced very many Eurozone and non-Eurozone banks to focus very, very heavily on their data infrastructure.
Okay, great. Thomas, make sure you pass this on to your colleagues in Kaiserstraße. May I just follow up, Julie? And you mentioned already digitalization. And the one question that came up here in the Q&A box is about digitalization strategies and how do you assess them? But I mean, you've kind of discussed this already a little bit, but maybe two other issues related, which you also touched upon a little bit. With digitalization, of course, comes cyber risk and how to address that. And the other question is, that I see here is to what extent does artificial intelligence represent a real pathway to maintaining, if not improving, long-term growth? So should there be really a focus on AI as the kind of the main pathway to long-term sustainability for banks?
I think AI, depending on your level of tech maturity, AI may be seen as something to strive for going forward once you get your data stack in order and you can start using your data. But if you do have a decent data stack, and then you can start using AI to get way better customer services. And what we see, both from I think one needs to recognize that in the world we live in, consumers, and especially those that are slightly younger than myself, they do expect to be able to do everything on their wonderful cell phone. And they do expect to get an experience that resembles the experience they get when they use Netflix. They want recommendations that are tailor-made to them. They want recommendations that fit their profile across the financial services that they are in need of, whether they have a mortgage or a savings account and a little bit of pension savings somewhere, and maybe they want to spend some money on going to school or whatever. They want that. And with the current cost structure of a banker, I can come to you and get that kind of advice, but I'd have to pay you as a physical person a quite hefty fee for an hour of very good information. And most households, they're not willing to pay for that kind of advice. They are expecting, however, that they get it on their app when they do banking, because they do expect that banks use the data that they have about their customers. That goes for households, that goes for corporates. And I think there are some limitations with human beings, the limits to how many systems they can go into in order to ensure they have the relevant files. So basically, the only way of servicing a mass market, the only way of servicing SMEs at a good level is to get the data stack in order, understand both the credit risk, which is obviously important from a risk management perspective, but also what are the needs of the customer and of similar customers, and what might that customer want from you on top of what he or she asked for when initiating the conversation. And that's where I think AI comes in. And we do have to remember, and I need to repeat this point, sorry, that our big competitors going forward, they're unlikely to be other banks. They are going to be Facebook and Google and Apple and Amazon, who have invested heavily in these kinds of techniques for years. So if we don't get there, they will take away our customers.
But would that imply, sorry, I'm follow up here, but maybe you're taking it a bit far away, but does this imply that you want to build up, that banks should build up this capacity in-house, that they should buy it in from fintechs, for example, startups, or should they just partner with big techs? Or it depends really on the circumstances?
It depends on the circumstances, and I think it depends on what type of bank you are and what bank you want to be. Clearly, there are some choices to be made by bank boards. One is, and you mentioned overbanking. Do we want to be everything to everybody, or do we want to specialize in something? Okay, we decide we want to specialize in something. Do we have the data regarding our customers and the products and services that we want to and have historically offered those customers to provide those services in a good way? How can we enhance that? Do we use people or do we use tech? If we want to go the tech way, do we build it in-house? That may be a good idea. It may also not be a good idea. I see many who very successfully implement basically a hybrid model where they have a lot of competences in-house, but they also do a lot of partnering with fintech startups in order to benefit from the rather massive development or evolution that is happening in the fintech space these days. Because there's always a new app, and it may be super hip and very in demand by customers for a year or 2 or 5, but then it's out. So maybe you just want to cherry pick what you think of as the best and integrate it in your tech stack, but you don't necessarily want to copy or develop everything in-house.
Yeah, thank you.
As for cyber, super important. If you are not on top of cyber risk, find someone that is and partner with them, because it's going to, yeah, it's big.
Yes, okay, and I think that's also yet another topic for another seminar. Thomas, if I may turn to you, there has been a question on whether the kind of the tiering of interest rates, for example, or TLTROs, that they can actually kind of address partly the problem of bank profitability that comes from these negative interest rates in the euro area.
Well, I mean, I think the answer to that is that these are monetary policy measures that are intended to ensure that banks are still in a position to support the economy by lending. And in that sense, and of course, they need to do that at a profit, right? So in that sense, they are patches that help. So the tiering helps to offset part of the impact of the negative rate on the deposit facility. But of course, on their own, I would not say they can be the solution to the more structural profitability problems that euro area banks are facing. So they can support, they can assist. They are not designed to help banks retain profitability, but instead they are designed to ensure that the banks can continue lending, in particular the TLTRO. The TLTRO is time bound. So again, it's not something that one can rely on indefinitely. So they are helpful, but I don't think they are the answer to the fundamental structural problems of low profitability that also Mr. Constâncio very carefully also illustrated.
Yeah, thank you. So it's more like to smooth the transition, not to actually kind of address the structural issues. Thanks. So Vitor, are we in the kind of the perfect storm? I mean, so there's one question here, or one comment. Digital financial services require lots of energy. How can we manage this? The climate change challenge, the fintech development, and the low interest rate development, and having non-banks also arising. Is that like kind of the my words now, a perfect storm that will eventually result in more financial fragility on top, of course, of the whole COVID? I mean, what is the what are we going to do about this? I mean, the low interest rate is only one part of a bigger puzzle of lots of challenges for banks in Europe. Do we need a big shakeup, or how should we go about this? How should we think about that?
Well, of course, reduction of overcapacity and consolidation is needed in several or even most banking sectors of the euro area countries. And that's for sure one of the important things. I wouldn't be so concerned about energy costs going forward. It's not so impactful for banks. Also, even the issue of climate change, I see it as a long-term challenge and the problem for the banks. Of course, supervisors will start to impose higher risk-weighted assets that are brown. That will increase costs a little bit, but again, I think that the more short-term and indivisible horizon for banks in Europe and in the euro area is the question of the period when the support to the economy and people will end. Will end moratoriums, will end guarantees to credit, and all of that. When it happens, it will increase the stressful situation on banks in a big way, because it's not for nothing that we have had a big recession, which affects, of course, the performance of loans in a significant way, which has been avoided so far by this specific support. That will end. That will be, then we will see. And then, of course, it's also the fact that the recovery in Europe is much less buoyant and robust than in the US. It's not due to monetary policy, because monetary policy in that respect, in what regards private agents, has done a lot, and it's practically exhausted. Any small change in interest rates will not matter for private agent decisions to spend more. It helps the states to spend more. So the fiscal policy and the state budget has become a sort of transmission channel of monetary policy. And that's what has been happening, and is important and useful, because we know that the answer to secular stagnation is mostly about fiscal policy. And so the fact that in Europe, fiscal policy, there is again talk about the need to be very careful with levels of indebtedness, the tight a little bit, the expansionary nature of budget of fiscal policy in the previous year, and all of that. When we see the US with the bold experiment of trying to break the issue of secular stagnation by going very big on fiscal policy and dealing with the post-COVID scars, structural scars that COVID will leave behind. That is not going to happen in Europe, where only into 2023 we will attain the level of GDP of 2019. The US will attain long before that the trend growth, the previous trend growth of their GDP, not the level of 2019. So this is a big difference, and it will make a big difference for banks. I have been talking about the risks that the European banking sector will face after COVID crisis ends, and all these supports that have been in place will be dismantled.
Thank you. Yeah, I think this is, you touched upon another topic that I think will accompany us for quite some time, yes, including here at the FBF in terms of the exit strategy. And of course, you pointed to the elephant in the room, which is the fiscal policy. I mean, so Martin Sandbu recently also pointed it out in an article in the commentary in the Financial Times. And of course, it has, as you pointed just out, also again repercussions for the banking system itself. So, but let me maybe from the big picture kind of go again a step. Which relates to that though, to kind of a bit more on the bank level. So one specific question that came here up in the Q&A box, Julie, is you, but I didn't mention at the beginning, you were also actually in charge of the merger of the 4 Nordic Nordea banks. Do you think that currently, together with the digitalization AI strategy that you described, a different merger control assessment is needed to encourage more mergers in Europe, Euro area, or European Union more generally, to kind of address one of the issues that all of you have kind of pointed to the overbanking?
Oh, I have to ask you to specify your question. You said merger control. I'm a bit unsure about what you mean.
So I think, I mean, that there's one thing is, of course, there is, I mean, there's the stability assessment, which I think, and the competition assessment. And I think a lot of this is still being done primarily on the national level. And then, of course, there's also the competition analysis more on the European Commission side. So is that still a too kind of cumbersome process, or is it really more the market that hasn't really got its act together in terms of providing more mergers? Because we've seen it in Scandinavia, right? I mean, Nordea is across all of Scandinavia, several of the other Swedish banks. Why can't we see something like that more in the rest of the European Union?
Now I'm going to be brutal. We merged what was at that point in time, we were number 30 globally. We were a global SIFI at that point in time. So this is not about size, and it's not about competition authorities if you take out the very big ones. It's not about regulators. They have a lot of questions, as do central banks, and rightfully so, about liquidity provision and deposit guarantee schemes, but that's quite frankly, that you can deal with. You have to understand where they're coming from in terms of questions, and it gives you a lot of work, but it doesn't stop you. So from my perspective, I think if there is a will, there is a way. I think, at least from whatever limited experience I have from being a regulator in the Danish market, the key challenge to mergers are quite often not necessarily very stringent. They're rather emotional. We want to be a bank in this specific part of the world. We have a history that is 300 years old. My great-grandfather founded this bank. all those types of arguments tend to come up. Rarely do you have arguments about, can we run a more effective organization? You dive immediately into which person should be on top.
Mhm.
And I'm afraid that when I look at the broader European banking landscape, I am a bit surprised that not many more have followed in the footsteps of Nordea. Because if you look at Mr. Constâncio's slide, and if you look at the benefits you get from running one organization as opposed to 4 organizations, the benefits are quite obvious. You don't have to have a doctorate in finance to understand it.
Yes. Yes, indeed. Well, thank you. We have a few minutes left, so maybe if I just give quickly the word to Thomas and then maybe Vitor for you want to comment on what you've heard so far, Thomas. Also, maybe looking forward.
Yes, thank you, Thorsten. I mean, one thought that came to my mind, especially hearing Julie talk, is whether some of these strategies, well, 2 aspects. On your last point, I guess there is also an aspect that has to do with, you know, competitive power and with what this then also implies in terms of pricing of financial services for end consumers. And so consolidation might be a way, of course, for banks to increase competitive power and extract higher margins. But for the economy as a whole, it's not entirely clear to me that the benefits are on net there. The other point is, or the other question is, in terms of the dividend from digitization, I wonder there whether, and I mean, of course, it's something that needs to be done. That is clear. I wonder whether it is the answer to the profitability problem, in the sense that I think to some extent it's a zero-sum game. It's something that banks need to do in order to avoid attrition of their business from their competitors in the banking system, or also outside the banking system, as Julie very well said. But does it mean that that it's a way to increase profitability? That is a question mark to me. So let me stop there. Thank you.
Thank you. Vitor, Julie mentioned emotions. May I bring in the P word? Is it also about politics that we don't see more bank mergers?
Well, no, I don't think that phase has been overcome in general in Europe. You know, what we have seen in not so distant past will not happen in the same way nowadays. So I discount that obstacle. It's not like 15 years, 20 years ago at all. The banking union nevertheless has changed the environment and the mentalities. I was glad to see that Julie confirmed many of the things I tried to say about the Scandinavian banks, and it's well, it's important. I don't have the view of Thomas that digitalization is more or less zero-sum outcome. Of course, it requires heavy investments at the beginning, but then rewards come later. And what worries me is the sort of reaction of regulation and regulators in what regards the breaking of the bank's franchise in terms of being too favorable for reasons of being modern and going along with technology, trying to promote and benefit non-bank competitors to banks. That is already done in terms of payments. Banks have lost that, although as what characterizes a bank is the fact that it gets deposits regularly from the public and guarantees their use and return without a loss, 100%. That's what makes a bank. And in the fintechs using and taking over payments, in the end, still imply movement of bank deposits. But even that, regulators have been too loose in terms of trying to open these competition. Banks are really under stress, and banks are still in our financial systems the only segment of the system that ensures maturity transformation, which is a vital, crucial function of a financial system to ensure growth. Because most agents want to hold assets that are more or less liquid. That's the preference. But the economy requires long-term credits. And the banks do perform this function. And they should be, in my view, treated more carefully by regulators as a result of that. And I fear that the movement, of course, to be modern, to go along with technology, captures too much the minds of many regulators. So I am also more concerned about that than about the not so good effects of digitalization, which I think it's absolutely crucial. And I think, by the way, that many of these fintechs that in the minds of libertarians and others are destined to totally undo banking and banks, that will not happen because in the end, banks have the financial muscle to real digitalize and totally compete, even with better performances than many of those nimble fintechs.
Well, thank you very much. I think this was the perfect final word. I think you left off with a lot of challenges and lots of food for thought. I'd like to thank all three, Julie, Thomas, Vitor, for this very insightful discussion. I'd like to thank the audience for their questions and their comments and suggestions, and hope to see you soon again. Thank you very much. And have a good afternoon.
Thank you very much, Thorsten.
Thank you very much.